Hi, my name is Colin, Portfolio Manager at iFAST research team. Today I'll be sharing about the best and worst performing fixed income market for the third quarter of this year. Last quarter was a challenging quarter for global fixed income markets as many saw losses. The top performer was global high-yield bonds, returning negative 0.2%. On the other hand, the worst performer for the quarter was Asia high-yield bonds, which declined almost 4%. On a year-to-date basis, things look better as most markets managed to deliver gains with global high-yield taking the lead, followed by Asian investment-grade bonds. Year-to-date, key fixed income markets generally returned between -2.2% to 5%. One major driver of last quarter's rate return was the steep rise in US Treasury yields. Over the past quarter, longer tenor yields of the Treasury curve have risen at a faster rate than their shorter tenor counterparts. For example, the 10-year US Treasury yields jumped by 73 basis points while the 2-year yield moved by only 15 basis points. This was largely the result of market repricing higher yields after coming to a realization that US economic growth remains resilient, inflation remains sticky, and interest rates will likely stay higher for longer. Let us take a closer look at the top performing market, the global high-yield bonds. So the performance last quarter was largely driven by a rise in Treasury yields, which managed to offset a major spread compression across US high-yield bonds. At the moment, valuations for global high-yield bonds remains tight as spreads are lower than the long-term average. This also means that there is now lesser margin for error should credit fundamentals deteriorate, especially if rates were to stay higher for longer. Currently, fundamentals for most high-yield issuers are still decent, but we are seeing a gradual rise in credit risk. There are several factors that may put pressure on fundamentals such as earnings weakness, a maturity wall in 2025, 3 to 4% higher refinancing rate, and stress for floating rate issuers. Overall, we remain cautious on global high-yield bonds due to rising credit risk in a higher for longer backdrop and tight spreads that are likely underpricing the risk. Asian high-yield bonds was the worst performing markets in third quarter this year. This is not surprising considering the amount of negative developments that came from China property sector over the past few months. Looking ahead, we think that fundamentals for China high-yield issuers remains challenged and the outlook for China's property sector is to stay gloomy. A big part of this is due to the weaker property demand, weaker economic growth, and a lack of support from policymakers. While credit spreads have fallen from last year's peak, it remains elevated and might not fully reflect the credit risk. In other words, yields may seem attractive but mostly due to higher spread, which we think might not offer investors decent compensation. For this reason, we remain negative on Asian high-yield bonds and see potentially further widening of spreads driven by China high-yield issuers. To get the full analysis, scan the QR code or click on the link in the description below. That wraps up for the sharing this week. Catch us again next week for more investment ideas and updates.